Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 4th of January. I'm Daniel Lam, your host for the podcast. Yesterday morning, I went to my first 2 media interviews of the year. The tone from both hosts was somewhat cautious. Well, because the first trading session was in the red for global equities as well as for bonds. So today, I would like to talk about possible risk in 2024. First of all, a US recession remains the major risk to our relatively constructive investment thesis this year. The US remains the one beacon of strength in global growth. Upwards revisions to US GDP growth forecast have been going hand in hand with less constructive outlook for most of the major economies, i.e., the consensus is increasingly seeing that the US will be more robust vis-a-vis its peers. Now, robust consumer spending, fueled by excess savings built during the pandemic, and the tight labor market remains a source of resilience for the US economy. However, job openings are on a downward trend and point to an eventual end to a labor deficit around mid-year. The second risk is an unexpected rise in inflation. This could be due to factors such as deepening in the existing conflicts in the world, resulting in larger-scale wars. This may result in stock-bond correlation going more positive, i.e. diminishing diversification effect of holding stocks and bonds, such as what happened in 2022. Now, neither of this risk is our base case. We have a 40% probability of US soft landing and 30% probability of US no landing. And we expect inflation to gradually come off. But if one or both of these risks were to happen, what would be good hedges for these scenarios? Well, in the recession case, US government bonds has historically been a good hedge due to potential pressure on longer-term yields. Our preference lies in high-quality bonds for their attractive yields and the likelihood of prices rising further, as DM economies may weaken in 2024. Now, we're expecting that the US 10-year government bond yield may soften further to 3.25 to 3.5% over 6 to 12 months, and we prefer an average US dollar bond portfolio duration of 7 to 10 years. Now, in the case where stock-bond correlation goes more positive, there are useful diversifiers historically, such as liquid alternatives, gold, as well as quality stocks. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.